This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap Podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and make profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast. Welcome to the Planet MicroCap Podcast. I'm your host, Robert Kraft, and thank you all so much for the support and for tuning in. You can follow Planet MicroCap on Twitter at Bobby K. Kraft. That's BOBBYKKRAFT. You're listening to episode 191. If you have any questions or comments, please feel free to tweet at me or shoot me an email at rkraft@snnwire.com. And when you do get a chance, if you like what you hear, please rate and review Planet MicroCap on iTunes. It really helps provide feedback for me and spread the microcap message. For this episode of the Planet MicroCap Podcast, I spoke with David Polansky. He is the co-founder and managing partner of Immersion Investments. David very recently launched his fund, Immersion Investments, in June 2021. So it was a pleasure to welcome him on the pod to better understand his investing philosophy and approach. We spend the majority of our time breaking down the ideal Immersion Setup, which are companies that fall into one or more of the categories listed in the title of this episode. I had a great time chatting with David, and I'm excited for him as he embarks on this new journey. Thank you again for tuning in to episode 191 of the Planet MicroCap Podcast, and please enjoy my conversation with David Polansky. Welcome back, everybody, to the Planet MicroCap Podcast. I'm your host, Robert Kraft. You can follow me on Twitter at Bobby K. Kraft. That's BOBBYKKRAFT. And I'd like to introduce our next guest here today. This is a gentleman who we had a pre-podcast chat, and that was the first time that we really spoke. And he just launched this fund very recently. And I thought it'd be really fun for him to come on and tell us a little bit more about that, and then all the things that we have in common and stuff. And with that, David Polansky. He's the co-founder and managing partner at Immersion Investments. David, what's happening, man? How you doing?
Thank you, Robert. Thank you so much for having me. I'm really excited to talk.
I'm just very happy that I inspired you to to embrace your inner audio engineer and got a new mic just for today. I mean, that's pretty neat.
I did. I got a new microphone just for you. Absolutely. Yeah.
I love it. And wait, you also were telling me just offline, and I have to press record when we get into things that we find, all this stuff. But yeah,
of course,
you're an audio engineer because you were in a band in high school, right? And you played drums.
Yes, I was a drummer in a metal band. I don't know if it was metal. It was more mix of punk rock, metal. I don't want to say the name because I don't know if I want my LPs to find me. But it was something I did from actually middle school all the way through high school. Yeah, we recorded an album, toured around, and I was also doing audio engineering too. So
that's so awesome. Wait, so you had the double kick drum then, of course.
Oh, absolutely. I actually have an electric drum set right behind my camera right here. I can't turn my computer around, but it's got a double kick and everything.
Oh, that's so fun. So I'm glad to hear that you're still playing. I unfortunately, I wish I could say this. I'm also a drummer, and I did jazz drums from 5th grade through 8th grade, and then sports took over.
Yeah, that's life. I didn't really play all through college up until actually last year. This drum set was a little COVID treat to myself. So it was fun to get back into it.
I want to get one of those electric ones because my excuse has been having a drum set, where can you set up a drum set in an apartment or a condo or anything like that? And of course there's all these amazing electric drum sets out there, and I'm just being, I don't know. I mean, I know there's not that expensive one. I know there's obviously the really expensive ones, but there's some that aren't that bad.
They're awesome. They even the mid-range ones, they feel like the real thing. Like the technology has just gotten so good. So definitely do it. Get back into it. Bite the bullet.
So then I have to ask, in the middle of playing in a punk metal band and being an audio engineer, where did your passion for investing start? Sorry, that was my segue into getting into this. I don't know if you saw, I don't know if you caught that, but that was it.
Yes. Yeah.
Okay.
Yeah. I figured that's where we were going with that. My passion for investing, when did it start? My passion is it's like constantly in development. Like I'm always learning, always trying out new things. I think I had an early concept of business and investing just in my household because both of my parents were entrepreneurs and they ran their own business. So I would I did something really, I used to do funny things. Like I would take my rock collection and my trading cards when I was really little. I would go out in the backyard and I would bury them in the yard. And I would go back inside and I'd say, I'm going to go back and I'm going to go get those when they're more valuable, when I'm older. I'm going to dig them up and I'm going to sell them. So of course, that didn't go over well. I had to go dig them back up and then I had to replant the dirt and the grass and all that. But it was I think I just kind of always had a little bit of that muscle within myself. And then I actually skipping ahead a little bit into college. I actually went to school for psychology. Originally, I quickly realized I didn't really have the personality for that. I was much more interested in business, learning about business, learning how people make money and sort of build things. And in the meantime, I had this stock portfolio on the side that I had started in high school. So I figured I could get into investing because that's kind of an interesting mix of psychology and business. I was fortunate enough to I went to the London School of Economics for a year during undergrad. And I learned there that you could actually get paid. You could have a real job picking stocks for other people. So I thought picking stocks for other people was insane. I thought that was something that you really only did as like a side job and that was aside from your main gig. So I started learning more about that and how to do it. I took some accounting courses and I really liked them. All my peers hated accounting, but I thought it was really fascinating. So I started to sort of incorporate income statement analysis, balance sheet, cash flow into my investing process. Because in high school, like I think how a lot of people get started is it was really more like a Peter Lynch approach. Like I would see a product I like, oh, I like Domino's. Oh, I like XYZ product. And you buy that. I started to abandon that a little bit and start actually getting into analyses of the business and those sorts of things. But I wasn't making a lot of money initially, and I realized it was because I was following a more so quantitative approach. I was looking at PE ratios, price to book ratios. I was looking at current earnings and current financial statements, which everybody has access to. So I've developed my approach over the years to be more sort of a investigative approach. So learning deeply about each and every business, trying to forecast that out, seeing how it can grow, and not really paying any attention or a little bit of attention, but not much attention to the current state of affairs, more so trying to think about where things could be way down the line. So I'm not sure if that answers your question. I guess where did my passion start? Started in the home, and I've just developed it ever since. So
very cool. I mean, was there a certain strategy or philosophy that you kind of gravitated towards? I mean, you kind of answered that a little bit, but like in particular, did you read any books, or was there a certain thinker, or did you see yourself as the next Warren Buffett? I mean, come on, we all had those illusions of grandeur when we were in our teens and 20s, when we were thinking about, I'm getting my start investing. I'm going to be the next Buffett.
I definitely had that inclination. I think after you get your first good, I mean, some of it were trades too. Like back then, like I would buy something, it would pop 50%, and then I would sell it. And then of course it would go up another tenfold, and I should have just held on to it. I didn't actually grow up with Ben Graham or Buffett or anything like that. I was mostly self-taught, frankly. So I didn't really have that. I eventually got a hold of The Intelligent Investor, and I started reading more of those classic style of books. And honestly, they kind of hurt me, because I think when something becomes that popular that it comes down to the layman on the street and everybody is aware of this strategy, it's very hard to make money doing that, because all of that information has been priced in, because markets develop over time, of course,
right,
and things get more and more efficient. So it was I did try to incorporate some of that, and it didn't work. I mean, it just doesn't really work for me at least. Maybe it works for other people.
Do you think that might have been timing, or do you think it was more just like, you know what, this doesn't jive with how I want to approach investing?
Oh, well, I would do like Ben Graham screens and those sorts of things.
I see. Yeah.
I would uncover, emerging market steel companies trading at a third of book value. And I would buy them, not realizing that the CEO is going to steal all my money and leave me holding the bag. So I never really considered that stuff early on. I didn't consider that, and the importance of, some of these other things like the business quality, growth prospects, management quality. Those were all things that came later, as I think they do with a lot of people.
Right. So it's interesting. So it's not so much that it didn't work. Well, it didn't work for you, but that's only if you only stuck to just looking at the companies based on how it screens, right? And not doing that follow-up qualitative and saying like, oh, well, there's a reason why this steel company might be, where it's at.
Right. And when I read those books initially, I was thinking, oh, well, this is how this guy did it, 50 years ago, not thinking that over the course of 50 years, maybe things develop, maybe they evolve, they get priced in. So I was trying to learn from the early greats, and it wasn't really working. So
gotcha. Very cool. All right. So real quick, catch us before we get into your strategy and everything, catch us up to today. Tell us a little bit about Immersion Investment Partners and your, how you got to that point.
Sure. Yeah. So Immersion Investments is a company that I co-founded with my partner, Tim Delaney. Prior to launching the firm, we worked together for 5 years at an investment manager in Boston. He was the head of investment strategy, and I was the lead analyst, basically in charge of public market equity due diligence and ongoing monitoring. We launched our fund on June 1st, Immersion Investment Partners, which is a small and microcap long only partnership. We specialize in companies less than $5 billion. We are highly concentrated, I would say. We own about 10 stocks right now, and the top 5 make up roughly 80% of our AUM. And I'm sure we'll get into some of the nitty gritty in a minute, but just sort of at a high level, we're looking for fundamentally good businesses run by good managers, trading at very cheap multiples on out-year earnings. That's kind of a generic answer. There are a lot of managers that say that. I think what's different about what we're doing is that with names that we buy, there has to be some level of misunderstanding, obviously. I mean, you need to be against the consensus. So there's some aspect of it that either the market doesn't like, there might be an aspect to it where there's a hidden asset buried within it, or it's a business where good fundamental economics are masked by current spending, which means they might not earn a lot of money right now. So that's kind of the high level of what we're trying to do.
Well, I'll tell you, you picked a good segment of the market for that, because microcaps, basically all assets are in retrospect kind of hidden. so and then sub billion, they're still small enough where, there could be some kind of asset in there where you're like, wait, they're not really monetizing or doing anything, or that could be a huge catalytic event if this happens. And then now that becomes way more valuable than even management probably perceived.
Yes, 100%. Yeah.
Yep. So so you kind of got it started getting into it a little bit in terms of Immersion's guiding investing principles. So can you go through those real quick as well, so that I want more. I want to understand it even better.
You want more? I'll give you I guess one aspect and one principle we live by is we want to make money. We want our stocks to do well. We want our stocks to go up a lot, of course. But we also are looking at the downside. So upside isn't just the most important thing in and of itself. We want asymmetric setups where if we're wrong, we're not going to lose our shirts. But if we're right, we can make many multiples of our money. We think in terms of end state economics when we look at these businesses. So we're not so much looking at the GAAP earnings or cash flow, but given sort of the underlying business, the customer, the unit level economics, what will this business look like at maturity? So in order to make sure that we're not going to lose our shirts, we have to ask ourselves, given sort of these steady state operating results, maybe 3, 4, 5 years out, how certain are we that that's going to occur? So certainty has to play into it. How sure are we that's going to happen? And if it doesn't happen, what is that going to mean for us? So it's not just, can we make a lot of money on this? There are a lot of stocks where, you look at them, they're growing really fast, but maybe everybody understands it. Maybe if you're wrong, you're going to lose 50, 60, 80% of your investment. So we're trying to look for these asymmetric setups where if we're wrong, it's okay, but if we're right, we'll make a lot. The other factor I did want to touch on is we don't want to anchor either. I think as much as managers will say that they're fundamental based, a lot of them will look at the stock chart and they'll say, okay, this is a good chart, this is a bad chart, this has gone up a lot, I might have missed it, which generally over long periods of time tends to be true. I mean, the chart should match the fundamentals over time, but it kind of ignores catalysts like changes. So if you're just looking at that and saying, I can't really buy this thing, we don't try to do that. We try to really take a good hard look at what's going on, what kind of business is it, and if it's a bad business, is there anything that's going to change that? Are they working on another product? Are they going to offer another service that has this whole other growth avenue, or is there going to be a new management team, new board, something like that? So those are a couple more of our principles. Yeah.
Very cool. So I want to now get into, there was this one section in your Q2 2021 partner letter where you described the ideal emergence setup. And you have some I love how you described each of these types of companies. So, for our audience that hasn't read that letter yet, how do you categorize some of the companies that you look for? And then maybe a brief description of each, and then, maybe why you broke it down the way you did.
Sure. Yeah, absolutely. So for those who don't know, the ideal immersion setup is like the type of investment that we like to look for. And really the impetus to come up with this list, or this, not really a checklist, more of these archetypes for what makes a good investment. We were thinking of what is a sustainable source of competitive edge. We know that anything that can be easily quantified and dumped into a model or a screening tool probably isn't a source of edge, because those things can be quickly distilled by people with much better processing and analytical or computing power than we have. So all 5 of our setups are really types of investments that can't be quantitatively screened. They're things that require you to either look somewhere else, like looking off the beaten path. So that might be kind of a strange exchange or a strange index, or maybe a name that's not in your index, or it requires a lot of fundamental work. Because if you just look at the business on the surface, you might say, oh, that looks bad. But if you do a little bit of digging, you can say, okay, if this business continues growing at this pace, it'll actually be a pretty good business in 5 years, or things are getting better. So those 5 setups, the ideal immersion setups, are the Underdog, the Babushka Doll, the Social Pariah, the Ugly Duckling, and the Doubted Champion. So, and any different, all of our investments can have one or more of the following trait. It doesn't need to neatly fit into one of these buckets. Actually, a really good investment would be one that fits into almost all of them, that we would consider that the, I don't know, it's not a trifecta, because trifecta is 3, whatever that would be for 5 of the factors.
The gold. Well, I know 4 was the golden sombrero. Wait, that's 4 strikeouts in baseball, so maybe not. But okay, all right, we'll figure it out before the end of this pod. We'll give it a name.
Right, exactly. So the Underdog, that one's pretty simple. That's something that's too small to catch people's attention. It trades on a bizarre exchange. It doesn't have any liquidity. The Underdog is a fundamentally good business, and it might screen that way if you were to screen it, but there are transitory factors to people buying it or funds to buy it. Obviously, if it's on an exchange, it doesn't have any liquidity and it's very small. That'll prevent people from purchasing it and prevent it from becoming discovered. Lack of analyst coverage is another factor here. I remember in my early investing experiences discovering some, smaller names and bringing them to friends and colleagues that worked at larger funds. And they would say, I would pitch them the name and they would say, okay, that's great. I can't buy it in a million years. And I'd be like, okay, why? They'd be like, well, it has to be over $1 billion. I'd say that's crazy. Like you should at least buy a little bit. I know if you're running, $50 billion, it's very hard, but you should at least try. You should at least try. But they would say, nope, can't even look at it. Just going to be tossed right in the trash. So that's the first one. The second one is the Babushka Doll. So that is a hidden asset or assets within a larger company that has significant potential value, and that if you're partnered with a management team that's willing to unlock that either through a sale or a spinoff, that can be really valuable. Now, a good Babushka Doll setup will be one where on the surface, maybe the company hasn't grown revenue in 10 years, profitability hasn't done anything. But if you take the time to look at the different segments or the different areas of the business, you can say, okay, there's actually something in here that's growing really fast. It's small compared to the overall whole. But if it keeps growing at this rate, then someday it could be worth, XYZ multiple of the current stock price. A good recent example of this, and this is not a stock that we own, neither of these stocks, but was Ferrari when it was spun out of Fiat Chrysler. I think that was a pretty good recent example of a good Babushka Doll style investment. The third one is the Social Pariah. This is a name where when you say it to a friend that works at a fund, they immediately scoff at you and they tell you that that's a horrible idea and you're going to lose all your money, which is usually for a good reason. I mean, there are a lot of very smart people in this industry, obviously. But if you take that attitude and that approach towards investing, you will miss catalysts. You won't be able to identify changes that could maybe result in significant future value creation. Such things as, like I was saying before, like a new product, a new service, a management change, or some opportunity for the narrative on the stock to shift from where it is currently. The fourth one is the Ugly Duckling. As the name kind of implies, this is a business, it's a unit economics story. So it's either a retailer or maybe a SaaS company where each sale you make or each sale you make to a customer or each new location or retail store you open has really good economics in and of itself. But on the surface, it kind of looks like junk because they're either burning a lot of cash, they might require capital, so they might dilute, they might have to raise debt or equity financing. But under the surface, kind of what's going on there is that it's a really good investment. And so if you can build a case where they can scale and ultimately that profitability will come through, we think that's really, really powerful. So that's the Ugly Duckling. The last one is the doubted champion, or colloquially within our company, we call it the Tom Brady effect, where the most common counter argument to owning a doubted champion is that their returns or growth cannot possibly sustain going forward. So in other words, it's a company that for some inexplicable reason, well, inexplicable to the layman, they just can't foresee them growing past where they've already been. But a good doubted champion, one that works, is one that continues to grow at a really fast rate. That's usually due to some qualitative factor within the company, such as differentiated product, service, a good culture, a superior culture. That can also create a doubted champion. But ultimately, it's kind of where the heuristics fall apart. People quote base rates a lot, and they'll say, okay, so, only 5% of companies can grow sales. And I'm making this up. I don't know if this is actually the case, but they'll say something to the effect of only 5% of companies have ever grown sales more than 15% for 10 years or more. So instead of determining if this thing that you're looking at can do that, they just say, yeah, it can't happen. And I mean, we all have, rules of thumb. We all have heuristics that kind of make sense to us and help save us time. Because frankly, doing the work on all these types of setups and trying to figure this all out takes a lot of time that most fund managers probably don't have. But we think that it's really important to do the work and try to understand what's happening. So these are the 5 ideal immersion setups.
Very cool. I love all 5, and I think it's so you creatively organize in such a fun way that I think it's a really simple way in some ways to be able to kind of, when you see a stock, you're like, oh, that's a doubted champion. Oh. But to follow up on all 5. Do you have an example or an anecdote of one because I think you said at the outset that the ideal of the ideal is that you have a stock that fits that fits most of the categories, right? So, I mean, have you had an experience where you're just like, wow, it hit every category, like this is it. And then maybe what happened from there?
So we've only been running since June 1st. Remember that. So
right, of course.
We don't have a long history. I'll say.
Yeah, but you've had this in your head, Right, okay, yeah. Sorry, you wrote this in Q2 for your Q2 letter. Yeah. But you didn't just come up with this, okay? On May 31st.
We named them. They were always in there. It was always in our brains, like just
okay, all right.
Kind of. I don't know, just swashing around, I guess, like kind of as a general framework. So what we did was we actually said, all right, this is what they're called. But a good recent one, and this was intended to be a day one investment for us, was a company called At Home Group. The ticker was HOME. They're now taken out, so they're private now. But that was a true ugly duckling because each new at-home retail store generated really phenomenal unit economics, but on the surface, the financials didn't look too good. They had a lot of overhead costs. They were burning cash, spending a lot on CapEx. But they were also hated. The history of the stock wasn't very good. It was another one where if you kind of look at the price of the chart, since I think they came public in 2015, 2016, and it was not a good journey as a public company. So that one kind of falls into like the Social Pariah and the Ugly Duckling bucket, if you will. Yeah.
Got it. Do you have any other stories where, especially since starting the fund in June, when you're looking at the different buckets, a funny combination of some of these buckets, or one that you thought was one, but it ended up being part of another bucket?
I think there is one that we currently own. It's a company called IDT Corporation, and it fits into the Underdog. It has no sell side coverage. It's extremely illiquid. There's really no good market for the stock. The intraday volatility is insane. So that's an Underdog. It's a Babushka Doll in the fact that IDT has 3 assets inside of it, growing 30% plus, and we think it can continue to do so for at least the next 5 years. And at maturity, or as I was saying, like kind of in the out years, we think that those assets are worth substantially more than the business as a whole today. And it's somewhat of an ugly duckling because they have a software product. They have 2 software products inside of it, actually, that are currently burning cash. And so if you look at the financials, you might say, okay, well, this company's losing money. It's not that great. Maybe it's not a really good industry. But when we dive in more into the subsidiary, so we're going into the company level, and then we're going into the subsidiary of the company. We found that the unit economics of each new customer that their software assets were signing on were really, really good, really good. So that's 3.
I'd argue it also maybe, and I'm not a shareholder, but I'd also would argue it might be a data champion. Growing, three assets in the business that are growing at 30% year over year. I'm sure there's quite a few people that are saying like, no way, that's not sustainable.
Yeah, and I think you could call it a doubted champion because the family that runs it, Howard Jonas and his son, who is now the CEO of the holding company, they have, I think, since they IPO'd the business in '96, IDT and all of the spinoffs that they've done, they've cumulatively generated about a 13% annualized return versus the Russell, which is at about 7 or 8. So they've done substantially better than their index. But for some reason today, this stock is extraordinarily cheap. And there are a few reasons behind that we don't have to go into. So yes, for sure.
For sure. Yeah. And by the way, and this is me talking directly to the audience for a second, I did an incredible episode with Joe Boscovich, where he literally like breaks down IDT. Well, he talks about Howard Jonas and the genius of Howard Jonas, and then breaks down IDT and all the different spinoffs. So I highly recommend everybody go and check that out. I have a feeling David probably listened to that too.
I did listen to it. It was a really good episode. So everybody should go check it out. But if you want to know what the future spinoffs are, the future, really high quality companies, go look at IDT itself. Go give it. I'll spare you the pitch, and we can keep going.
Fair enough, man. Well, all right. So I asked you like on the positive side, on the downside, what was one, based on the buckets, you're like, all right, this fit one of the buckets, this looks good. Why not, love to hear an anecdote there where you learned a couple lessons.
Where it didn't fit into a bucket and where we learned a lesson.
Or you tried to fit it into a bucket, like, oh yeah, no, this is an ugly duckling. Oh, this is a babushka, but it may not have actually been. You just, you wanted it to be.
I don't know if that's I think the 5 factors are almost an output to the process rather than an input.
Got it.
So it's almost just like, that's what we like naturally gravitate towards. And then like, most of our names will fall into these buckets, but we won't be like, we need X amount of this, we need X amount of this, or X amount of this. We're not trying to limit ourselves in that respect. Because I guess actually the one thing that made me nervous about putting out this list is, maybe in the future, if we're talking to investors and we change our minds. I mean, we want to have the ability to grow and to change our minds. And people might say, okay, well, if 5 or 10 years down the road, they say, okay, well, what is this one? And we say, well, actually, that one is maybe outside of the scope. And then they might say, well, are you fickle? Are you not sticking to your philosophy? But I want to have the ability to grow, I guess, would be how I put it.
Fair enough, man. I like it. So, you talk about portfolio construction a little bit. You say you're ultra concentrated, 10 holdings, the top 5 make up 80%. What was your thought process there? And once you how often do you find a new idea?
God, not often. Not often, because it has to. It has to be a good business. A lot of good businesses are appropriately priced or overpriced, right? So we don't find them that often. I don't even want to put a time limit on it. I would say the other part of your question, which is why so concentrated? Because there aren't that many great setups. It's just the reality of the beast. And if we find a name, I guess with Tim and me in our past life, it really stunk when we were super, super right about something and it was only 3% of the portfolio. And we tended to be, not to be arrogant, but we tended to be right more than we were wrong. So we said, hey, if we see something that is clearly so asymmetric and is really interesting because nobody else is looking at this, we wouldn't want that to be a small percentage of the portfolio. So that's why we're concentrated. Yeah.
Very good. So, knowing that you're so concentrated, how do you then size into some of your positions? I'm assuming that takes a while.
I almost feel like I'm contradicting myself a little bit, because we will do like little starter. Well, they're little to us. We will start with a 3 to 5% position and then scale up from there. But again, these things are in motion. So on June 1, when we launched, we had a portfolio. Like we knew what we were doing and we bought it. And it's only been 3 months, so it really hasn't changed since we started. So if I gave you a complete answer right now, it might be different in the future.
Right. Yeah, I think that's a good point to bring up. Like, you literally just started the fund, so you had to deploy the capital and make, you had the ideas in mind that you're going to do. So it's just a matter of putting the money to work right away. All right. So then my next question, this is my favorite question I ask everybody on here. What would you say is an investing experience that impacted your career the most?
I'm tempted to give you my gut reaction is to give you like a good or a bad experience,
or both.
But I could do both. But I think I've been becoming more cognizant lately of false lessons or developing rules of thumb that won't really apply in 10 years, because I guess it wasn't in investing a single experience, but a lot of experiences of pitching to somebody who was older than myself and them using a frame of reference that was 30 years old and not really updating it for how the current world is or how businesses operate. And they're missing out on something that could have made them a lot of money. And I think that happens with a lot of really famous popular investors too, is like they made their money in one in one area, in one bucket, or doing one thing super, super well. And then they kind of don't update their views, or they kind of hang on to those rules of thumb for too long. So it's not a single experience that changed my career, but it's a series of experiences and like constant reminders that like, I need to, it's weird because like investing is so strange because you need to be steadfast in your views and have conviction, but you also have to have the ability to change your mind when the facts are different. So it can be tough, but I keep reminding myself that, I think we found something that will make us good money over time. I think we're going to do really well. But also we need to be open to different things, that things might change.
Got it. All right. So I'll ask this question then a little differently. When you first got your start back in high school, when you bought those first couple stocks, what was there any experience during that time when you're first learning that would you say kind of impacted you in some respect down the road?
Don't buy mining companies. No. Yeah, see, that's again,
I just did like 100 interviews with junior mining companies that are on my YouTube channel.
Oh,
right now. That's okay. Great. I love it.
I just ended up on their no list. But again, that's a heuristic, and that's a rule of thumb that maybe I need to update. I would say this wasn't early. This was recently, within the last 3 or 4 years. And it hammered home the point of good people and people at the top. Engendering a really good culture within their company. We owned a firm, and we like to do some pretty good due diligence. So I like to reach out to employees at companies, current employees, not just past ones. And I was reaching out to employees. And then a couple months later, I was at the annual meeting. I'm not going to give the name of this firm, but I was at their annual meeting a couple months later, and the CEO actually pulled me aside in the midst of all the business and everything going on, and all the business of the annual meeting. And he said, "Don't reach out to my employees." He said, "I am the only one that talks to investors. You can't do that." And I was shocked. I had never, that one interaction said so many things about this firm that I think are really, really hard to put into a spreadsheet or to put into a model. So that was a lesson in the importance of management and having good management, and management that isn't maybe trying to hide something or is afraid of me talking to your employees. That was a very strange time.
That's a really great anecdote, actually, because when we're talking about microcaps, a lot of investors that come on here say that, as part of our due diligence process, we like to talk to not just employees, but customers or potential customers, even some of their competition, just to get a better understanding. So that's really interesting. I've never heard that a CEO actually coming up to you and saying that. I'm surprised it doesn't happen more. Honestly.
Yeah, it was it was a weird experience. Needless to say, we don't own that stock.
Yeah, to say the least. Yeah, some of the implications from that. I wonder. At the same time, you can kind of be like, all right, let me put my hat on. Let me understand his perspective a little bit, right? Of like, or their perspective. Excuse me. Is okay. You might not want your employees might not give the most accurate picture of what's actually happening in the company, both on the negative or even positive side, right? Yeah. So yeah. I wonder if that is like an immediate, like, all right, well, that's weird. They're obviously hiding something. Or do you have to stop yourself and think, all right, well, maybe he's trying to protect his employees from saying things that also might not be public, right? And making sure that they're protected in some respects. But it sounds like this person was a little aggressive.
So my follow-up was, okay, then can you make them available to me and we can have someone else in the room if it makes you uncomfortable? And he said no. So
okay,
there you go.
There you go. Yeah. That sounds like an aggressive no.
that sent a chill right up my spine.
Oof.
Yeah.
That's wow. Yeah. No, there you go. Um, so, so as we're kind of rounding the bend here for our chat today, and again, thanks so much for taking the time. Like this is a lot of fun, and we'll definitely have you back at some point. But what would you, David? What would you say? Do you have any advice for new investors that are looking at small, micro, nano caps at this time right now?
I don't know if it applies to investing in general, I guess. So my advice would be take an accounting course. And you're when you say new people, I'm assuming you mean students.
Anybody, it could be students. Everybody, we're all students, right? You want to go? We could go down that road. You want to go full philosophy? Don't worry, I got a couple books here that we can talk about. We can talk about how we're all still students. But
you have a good setup. We just moved into our condo, and it's a little bare back here, but.
I used to have a shelf right here, and it was starting to kind of like Leaning Tower of Pisa kind of thing. I thought it'd be kind of a funny gag to like say, "Oh, the countdown to when the shelf finally like falls over and like all the books fall on my head." Yeah. Like the next California earthquake that we have that just, does that. But my wife vetoed that gag pretty quickly. We try and have fun in investing as much as we can.
We do try to have fun. We do try to have fun. I think you should do it anyway. You should bring it back. Yeah.
But I have this photo of me shredding. Like, how could I get rid of that now?
Is that what that is? I can't. I gotta full size my screen. Oh yeah, look at that.
I was in a barrel. It was pretty cool.
That's awesome.
Yeah. But anyways, okay. We were talking about advice. Advice.
Learn how to understand financial statements. And don't take that literally. I mean, just because you know how to model out a company and create projections, don't just be like, okay, well, this is the income statement, the balance sheet, and the cash flow. Go deeper than that. So, figure out like if they're doing a new line of business or they have a certain growth initiative. Like, okay, what does the math look like around that particular thing? Like that's where the rubber meets the road, because it gets difficult because obviously companies don't like to talk about that stuff. Some of them do, some of them don't. But really dive in deep to try and understand the companies and the drivers, and then the drivers of the P&L or the income statement, because really that's just an output of every initiative and project going on within the company. The second thing I would say, oh man, I'm going to get, people aren't going to like this. Don't blindly follow the advice of investing legends, some living, some dead. It worked for them, but that doesn't mean it's going to work for you. Things will get priced in, things will become inefficient, and you have to update your views and figure out how to make money. And
why would people give you shit for that one? That's great advice. I like that.
After I said it, like I was originally going to drop names, but then at mid-sentence I decided not to.
I mean, you're totally right. Like, look, everybody, like, it's great wisdom, it's great education, and then it's up to you as to how you want to implement it. You could go, word for word, or personalize it.
Yes.
This is something that works well for you. I mean, absolutely. I think, or create something new as a result of the old knowledge. And then we can get into the debate. Is that something new because you derived it from somewhere else? And then we could go down that road as well. Go full on modernistic take on what actually is new or not.
Yeah.
I don't know where we were going with that. I don't know where I was. But I think you got it. I think we got that.
I got it. Yeah. The other point I would say is learn how to communicate an investment or to pitch yourself and your ideas. I'm not good at it, but it's so important and something I'm continuously trying to learn. I mean, it's not just about getting an idea in a portfolio, but like raising money, building a business, like communicating is everything because there are so many ideas and there are so many managers out there. So you really need to learn how to pitch an investment, pitch yourself, pitch your business. And then lastly, get on FinTwit and talk about your ideas. Doing that changed my life in a lot of ways. So I highly recommend getting on Twitter. It's my My partner Tim said something. It's like swimming naked a little bit. You feel pretty exposed when you put your ideas out there, and I do too. But it creates a lot of great conversation, and also if people don't agree with you, they'll reach out and they'll be like, "Hey, have you looked at this?" And it kind of builds a network and helps you even more deeply understand what you own.
I could not agree with every bit of that advice that you said. That's all fantastic advice. I mean, especially going out there and networking and pitching your ideas, and just so you can get some good quality feedback. In fact, I hope you do Andrew Walker's show at some point. So that I love his format. We have different formats. I love how anybody can go on there and pitch a stock, and he gives some good quality feedback on that. So I think that'd be a good, hopefully you're on that one day.
That'd be great. That'd be awesome.
That'd be cool. But anyways, with that, David, dude, where can our audience go and find more information to follow along the Immersion Investments, and then also to follow you on social media?
Yeah, absolutely. So the social media, my Twitter handle is just David H. Polansky, Polansky. My partner, Tim Delaney, he has a great handle. It's Boring PM Guy. So that's Boring PM as in PM, then Guy. Love it. It's a great name. And then my email is david@immersioninvest.com. That's IMMERSIONINVEST.com.
Awesome. David, thank you so much for joining me today. I really do appreciate it. Good luck. Stay safe. I look forward to our next chat.
Thank you for having me.
Thank you. This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap Podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast.